In the last 30 days, the S&P 500 grew by 4.7%. The last time the S&P had a negative return was in March 2020 when it crashed by 8.6%. At that time, the index was trading around 2,400. Today, it's sitting comfortably above 4,800. What does this mean? Well, if the S&P 500 keeps growing at its current rate, it will hit a new record in no time. But we all know that markets don't grow in a straight line. So what do you think? When will the next crash happen? Will it be a Black Friday, or a Black Week, or maybe a Black Month? If you're like most investors and can't stand the volatility, this video is for you. Hi everyone, welcome to my channel where you learn how to build wealth slowly and steadily. In today's video, I want to talk about the most important index in the world, the one that affects each and every one of us regardless of where we live. It's called the Standard & Poor's 500, otherwise known as the S&P 500. Let's find out why it's so popular. First of all, let me give you a brief history of this index. The S&P 500 is a share price index. An index is essentially a basket containing shares of different companies. The S&P 500 contains the 500 biggest public companies in the U.S. based on market capitalization, which is the total value of all the shares of a company. The idea behind an index fund is to have a portfolio that mirrors the performance of the underlying assets. For example, if the S&P 500 goes up by 10, an S&P 500 ETF should also increase by 10, assuming that there are no fees involved. The S&P 500 was created in 1923 and initially contained just 268 companies. Since then, the index has grown tremendously, both in terms of the number of constituents and the total return. If you invested $1,000 in 1926, your investment would have grown to over $1.7 million by 2021. That's an average annual return of 7.6%. It's impressive, but it doesn't tell the whole story because such returns are only possible when you reinvest your dividends. Unfortunately, most investors don't hold their stocks for long enough to see these kinds of numbers. In fact, according to Dalbar Inc., the average equity fund investor earns a 2.5 annual return over a 20-year period. So much for the benefit of hindsight. Now let's take a look at the main crises in the history of the S&P 500. I'm sure that you've heard about the crisis of 2008. This financial meltdown happened due to the collapse of the U.S. housing bubble. When home prices started falling, people who took mortgages on properties that were worth more than they could afford found themselves underwater. To make things worse, many of them had variable rate mortgages whose interest rates were about to go up. As a result, millions of homeowners defaulted on their loans, which led to the downfall of some of the biggest banks in the world, including Lehman Brothers. This crisis didn't spare the stock market. The S&P 500 fell from 1,500 to less than 900 in less than a year, which represents a drop of 40. At that time, everybody thought that the world was coming to an end, but looking back, we can see that this drop was just a minor setback. The index recovered very quickly and continued growing. The next major event was even more traumatic for the U.S. population. It was the pandemic. By February 2020, the S&P 500 was trading at 3,300. 2 months later, it dropped to 2,200. That's almost a 33% drop. During that time, the world was fighting a new unknown virus. Vaccines didn't exist yet, and treatments were not very effective. The economy was completely shut down, and millions of businesses were forced to close their doors forever. The good news is that thanks to the enormous stimulus that was deployed by governments and central banks, the market recovered quickly. And by the end of 2021, the index was trading at 4,800. So why do I say that the S&P 500 is the thermometer of the global economy? Well, there are two reasons. The first reason is that the S&P 500 is a leading indicator. It doesn't reflect what's happening right now. Instead, it predicts what's going to happen in the near future. Investors who trade on the stock market aren't stupid. They know that if the Federal Reserve raises interest rates or if inflation goes up, those changes won't be reflected in the price of stocks until something happens. And when something happens, the stock market falls. Therefore, if investors expect something bad to happen, the price of the index falls beforehand. We can see this effect in action if we look at the evolution of the S&P 500 since 1950. The index tends to move in cycles. There are times when everything seems to be going great. People are optimistic about the future. The economy is growing, and that's reflected in the price of stocks. Then suddenly something goes wrong and the market crashes. These cycles typically last between 8 and 10 years. If we're at the beginning of a new cycle, it means that the good times are ahead of us. If we're at the end of a cycle, it means that a recession is coming. Right now, we're in the middle of a bull market that began in March 2020 when the index bottomed out at around 2,200. Since then, the S&P 500 has been growing steadily and is now trading at levels that we've never seen before. According to Bank of America, this bull market still has room to grow. Their analysts believe that the S&P 500 will reach 5,000 by mid-2022 and 5,500 by the end of the year. The second reason is that the S&P 500 is a global benchmark. Even if you don't invest in the U.S. stock market, you should keep an eye on it. Here's why. Let's say that you live in Europe and you think that the S&P 500 is irrelevant to you because you do not own any American stocks. You couldn't be more wrong. Your bank, insurance company, or pension fund probably invests part of its assets in an S&P 500 index fund. And because these institutions have a fiduciary duty to get the best possible returns for their customers, they must consider what's happening in the U.S. stock market. After all, it's the biggest stock market in the world. The same thing applies to emerging markets. If you think that the S&P 500 has nothing to do with you because you live in an emerging country, you're also wrong. When things go well in the U.S., emerging markets tend to perform even better. The opposite is also true. Let's take a look at what the data tells us. Between 1995 and 2020, the S&P 500 delivered a total return of 8.3 annually. If we compare that return with other developed markets, we can see that they come nowhere near the S&P 500. The UK returned 6.3 annually, Japan 5.3, and Europe only 4.6. Emerging markets did better than Europe, but still underperformed the S&P 500. A lot of people try to time the market. They think that they can predict what will happen in the short term. The truth is that nobody can do that. If you try to guess whether the market will go up or down in the next few weeks or months, you'll probably get it wrong. The best strategy is to buy and hold. Just look at this chart. It shows the evolution of $1,000 invested in the S&P 500 at various times since 1980. As you can see, the timing of your investment doesn't really matter. Sure, if you bought your shares at the peak of the market, you would have lost some money. But if you held on for just another year, you would have made a profit. The bottom line is that you don't need to be a genius to invest in the stock market. Sometimes the best decision is to do nothing. If you like this video, please give it a thumbs up. Also, remember to subscribe if you haven't done it yet. Thank you for watching, and until next time.